Is interest rate uncertainty in the market context. Joining us now, Kristina Hooper, Chief Global Market Strategist at Invesco, and here in studio, Karl Schamotta, Chief Market Strategist at Corpay. It's great to have you both with us. Kristina, let me start with you and just your general observation of the mood of the markets right now.
Well, it's clear that markets are under pressure because the 10-year yield continues to move higher. We shouldn't be surprised whenever we see rates go up. It tends to put downward pressure on stocks. And this is a particularly significant move up that we've seen in the last few weeks. And so the mood is rather pessimistic. Having said that, though, this is what the Fed wants. We even heard Jay Powell and other members of the Fed say as much in the last few weeks. It helps, it's doing the Fed's work for it. And so it makes it less likely that we see any more rate hikes.
And Karl Schamotta, the speed at which all of this is happening right now, what's your assessment? I mean, what do you track the currency market, but also the fact that this is all happening quite quickly, particularly in the bond market?
Yeah, it's really interesting. I mean, you could look at it as a fundamentally driven move. We've obviously seen this massive ramp up in overall growth expectations and you know, that sort of resilience in data. But at the same time, it's also very clearly a demand and supply imbalance in the Treasury market. We have a lot of the sort of price-sensitive buyers being forced to absorb most of the Treasury issuance. We have the Treasury issuing a lot of long-duration instruments as opposed to short duration, and that is forcing yields up in a way that sort of, I think, is a little bit disconnected from economic reality. And so to Kristina's point there, this is, you know, clearly doing some of what the Fed wants, but it may be overshooting a bit. And so I wouldn't be too surprised if we were to see Fed officials beginning to walk this back a little bit, becoming a little bit more nuanced in their, you know, higher for longer communications in the next little while, to the point, you know, that they're sort of saying that it's going to be for longer, not necessarily for higher.
Okay, and then Kristina, you're monitoring markets around the world and providing advice to your clients based on that. For those who are trying to figure out what all this means for the stock market, how are you positioning right now? What's your recommendation?
Well, it's all about your time horizon. And for those clients, the vast majority of which have a long time horizon, it's important to maintain an asset allocation that includes exposure to equities. In fact, opportunities are presenting themselves because of the downward pressure being exerted on stocks. So what we're saying is the most important thing you can do is be well diversified. Have that plan and stick with it and look for opportunities to tactically allocate, given what seems to be an overreaction in markets that really started in September with the issuance of the new dot plot. I have to remind that dot plots can be wildly inaccurate. The December 21 dot plot suggested that the Fed funds rate would be 90 basis points at the end of 22, and we know how off that was.
Okay, and then Karl Schamotta, let's move less to plots, but plot lines, I suppose, with, as I mentioned, you've got, once again, the Premier of Ontario penning this letter to the Bank of Canada governor saying, please don't make a move on interest rates. And it has been a unique time where you've seen a number of provincial leaders try to send the message to our independent central bank. Whether Doug Ford influences the decision on Wednesday or not, what have you been seeing in the markets in terms of positioning around what the Bank of Canada might do this week?
Yeah, so, you know, monetary policymakers are clearly going to try to maintain independence. They're not going to make decisions based on this political pressure. It looks a lot like posturing that we're seeing from provincial leaders across Canada. That being said, you know, we're very, very, very close to a peak in Bank of Canada policy. That tightening that is happening in the U.S. is clearly transmitting into the Canadian economy and clearly tightening financial conditions, which should ultimately lead to slower growth. All of that said, what I would suspect that we begin to see here is a bit of a more nuanced communication from the Bank of Canada as well. They are going to, you know, maintain that hawkish bias on the front end, but also, you know, start to I guess, awake markets to the possibility of rate cuts coming in 2024 and beyond, right? So, you know, the issue that we see here in the Canadian dollar and in markets more generally is that right now the Fed is expected to cut more aggressively than the Bank of Canada, and you know the evidence coming in from the Canadian economy thus far would suggest that the Bank of Canada is very, very likely to actually match the Fed in its pace of rate cuts, which should ultimately put downward pressure on the Canadian dollar.
Okay, so lots of moving parts to watch. Kristina, just back to you because we highlighted that we saw a major energy transaction today with Chevron acquiring Hess. It comes within the last couple of weeks. You saw Exxon's big deal with Pioneer. Why are big companies pulling the trigger on major acquisitions if there's so much uncertainty in the air?
Well, because I think a lot of these companies are looking longer term, and they're recognizing that this is likely to be very short term in the way of hiccups. The reality is that the economy, the U.S. economy, and quite frankly, the global economy is still on relatively solid footing. Certainly, we will be experiencing more of a slowdown going forward, but these companies certainly see the opportunities out there and are not going to wait to get greater clarity on monetary policy, for example. They're going to move ahead because, as investors should, it's about the long term for so many.
And Karl, in terms of what's happening in the U.S. economy, how much does that ultimately influence the story for Canada's economy? I imagine you're watching the overall economic trends there as well.
Right. We are looking at a potential slowdown in consumer demand in the fourth quarter and first quarter of 2024. That should transmit into more economic weakness here in Canada. But the reality is that we are looking at two very, very different situations. If we look at private sector debt relative to GDP in the U.S., it's about 150%. In Canada, it's 216%. So, the Canadian economy is far, far more exposed to a downturn and to, the rise in borrowing costs that's occurring. So therefore, markets are taking a more skeptical view on where the economy will go here relative to the U.S. And in a very big way right now, the U.S. is the prettiest house in a very ugly neighborhood.
Before I let both of you go, we're going to go live to Israel in the next few minutes for an update on the situation in the war between Israel and Hamas. Kristina, on the geopolitical front, how is that influencing some of your views on where the markets go?
Well, we certainly are likely to see some market reaction in the near term, like, for example, the price of oil continuing to see upward pressure. Gold prices could, in fact, move up as investors continue to exhibit a preference for safe haven asset classes, although those safe havens can change over time. But the important thing for investors to keep in mind is that typically geopolitical risks, no matter how significant they seem at the time, tend not to have any significant impact, any material impact over the medium or longer term. And so that's important for investors to keep in mind.
And Karl, how are you watching the situation right now?
Yeah, so the interesting thing is the variegated effect of higher oil prices. Clearly the U.S. with its energy independence and Canada are relatively insulated from what's happening, whereas Asia is not. And so, the inflationary impact is relatively small here. One thing I would kind of highlight in terms of sort of short-term tactical positioning is what's happening ahead of each weekend in the last couple of weekends. We keep seeing a tactical move or flight to safety on Friday afternoon, or if not Friday morning, and that unwinds every Monday. So this suggests that markets are repeatedly worrying about what might happen over the weekend and then closing out those positions during the week. So it's kind of an interesting dynamic in which you can't necessarily take the signal that you're seeing on either Monday morning or Friday morning as indicative of what's actually happening more fundamentally in the long run.
Okay. So